Someone sent me an ad last week. AI software claims it can predict the stock moves 2 to 3 days in advance. 30 seconds in, I knew exactly where it was going. But it got me thinking about how many people actually believe this stuff and how many people are paying for it. So today I want to talk a little bit about technical analysis. Some people swear by it, others choose to completely ignore it. So rather than try to convince you one way or another, I'll let you decide which camp you fall into by the end of the video. For those that don't know me, my name is Nader Nasser. I'm a senior portfolio manager and wealth advisor with RBC Dominion Securities in Montreal, Canada. I've been an investment advisor since 2005, and I put out regular videos addressing investment planning and retirement strategies for affluent Canadian families and businesses. So today, what I want to focus on is what the research actually says and why the version being sold to most investors has a real credibility problem. You see, technical analysis is the practice of studying past price movements and chart patterns to attempt to predict where a stock is going next. Now, you may have heard some of the language around this. Support levels, resistance, head and shoulders, moving averages, Bollinger Bands, even Fibonacci levels and retracement. People spend years learning and trying to master this field of study. And I'm not going to tell you it's completely useless. That would be an oversimplification. What I will say is that the gap between what the research shows and what gets marketed to investors is enormous. Now, let's start with a few people who markets knew very well. Let's start at the very top. Warren Buffett. He's been pretty direct on this. He once said that he realized technical analysis didn't work when he turned the charts upside down and didn't get a different answer. Not exactly a ringing endorsement from the Oracle of Omaha. Now, Peter Lynch ran Fidelity's Magellan Fund for 13 years and averaged over 29% annually, one of the best track records in the history of money management. His take on charts and short-term trading was equally blunt. He said, "Charts are great for predicting the past." Now, to be fair, not everyone at that level dismissed it entirely. Marty Zweig was a very well-known market strategist and money manager. His claim to fame was when he went on the PBS show Wall Street Week the Friday before the 1987 crash, and he warned that a crash was coming. He was right. He used a combination of monetary indicators and yes, some technical signals. He's often quoted in favor of trend following, with the most famous quote being, "The trend is your friend." But even Zweig's approach was grounded in broader market conditions, interest rate cycles, and investor sentiment. He wasn't someone drawing lines on a chart and calling a trade. Now, there's a very meaningful difference between disciplined quantitative work and the kind of pattern reading being sold to retail investors today. In 1999, researchers at MIT published a study in the Journal of Finance. Certain chart patterns did show up more than random chance would suggest. Some statistical signal was there, but statistical significance and actual profitability are two different things. Once you factor in trading costs and taxes, most of the edge just disappears. And a broader review covering over 95 published studies found that the majority of technical trading rules don't produce consistent returns after costs. As for the strategies that did show some edge, well, most stopped working once algorithmic trading made markets more efficient and the patterns became widely known. And then there's Spiva, whom I mentioned in my last video. S&P Global publishes this every year. It tracks down how professionally managed funds perform against a basic index. People with Bloomberg terminals, research teams, years and years of experience. And over 15 years, roughly 88 to 92% of active US equity funds underperform the index. So when someone's selling you a $49 chart software subscription, you have to ask yourself, what do these gurus know that the professionals don't? And this is where I want to slow down for a second. You've probably seen these ads: AI trading systems, chart pattern alerts, stock picks that supposedly beat the market. And you see them on reputable business channels, Bloomberg, BNN, CNBC, channels you associate with serious financial coverage. And here's what's worth remembering. Those channels are media businesses. Their revenue comes from selling advertising space. And that's the model. Doesn't mean the editorial coverage is incredible, but an ad running on a financial news channel has not been vetted, reviewed, or endorsed by anybody at that channel. They're not acting as your advisor or as a fiduciary. The TV channel is not required to act in your interest. They just sold the airtime. So the next time you see a system promising market-beating returns and a fancy-sounding 30-second spot on a channel you trust, remember that the channel trusted them to pay the invoice. And that's a different standard than the one your advisor is held to. And this brings me to the part that bothers me the most about how this all gets sold. If a system reliably predicted stock prices 2 or 3 days in advance, you wouldn't be seeing ads for it. The people running it would be deploying billions quietly while laying on a beach and telling nobody. The business model of most of these platforms isn't trading profits, it's sell you a subscription. Same goes for advisors who lead with charts. Ask for the audited, long-term, after-fee track record compared to a single index. Don't simply settle for an Excel spreadsheet or cherry-picked client returns. Most of the time, when you ask the right questions, the conversation will come to an end. To be fair, I'm not saying no one has ever made money using technical analysis. Short-term traders use it. Certain momentum strategies have shown some edge in academic settings. But these environments involve institutional-grade execution and very low costs. And the strategies that work tend to get retired the moment too many people know about them. And that's not the environment most people are operating in. Your edge as an investor isn't a better chart, it's a clear plan. The right asset mix, tax efficiency, and the discipline to stay with it even when markets get uncomfortable. So the next time someone shows you a chart and tells you a stock is about to break out, ask one question. What's the long-term, audited, after-fee track record compared to a simple index? If they can't answer that, you have your answer. My name's Nader Nasser, and I put out content here for investors who want to cut through this kind of noise. Subscribe if that's useful, and I'll see you in the next video.